Anish, thanks for making time, and I've been eagerly waiting forward, for this chat. Uh, the optimism around India, right, and the global community is perhaps as high as it has ever been, and I think a lot of it is owing to the vision, energy, intelligence that founders like you bring to the table. Uh, over the next 45 minutes, I was hoping to dive deeper into what I'd call your labor of love, right? Capillary Technologies. Uh, Talk a bit about SaaS in India and also maybe touch on economics of SaaS companies broadly, right? Uh, so to kick us off, maybe can you describe Capillary for us in your own words, and share what you think were some of the major inflection points as you saw it, over the past 15 years of Capillary's journey.
Thanks, Karthik. Thanks for the kind words. I hope we were as half as smart as you projected us to be on the call till now. But yeah, quickly on pleasure to do this with you. Right. So quickly on Capillary, we started off in 2008. We are a software as a service play. We focused on very large enterprises. So our average customer base is close to $1 million a year. For those in India, if you've been to a Taj and you're part of the Inner Circle program, so we play in the loyalty management space. So the Taj Inner Circle program runs on us. If you've been to any of the Aarti Birla fashion stores, Louis Philippe, Allen Solly, Van Heusen, or the Pantaloons, etc. Again, if you're part of their membership, all that tends to run on us as well. Today, we work with about 16 of the Fortune 200, including folks like Adele in the US, Nestle for a bunch of brands in the US for them, Shell in many markets in Asia, Domino's, the Tatas, Aarti Birla Group, Landmark, a bunch of them, right? So that's what we do. We're about 800 folks now. We presence in about 40 countries, customers in about 40 countries. In terms of key milestones, we started off in 2008 with a small seed loan from IIT Kharagpur, where we went for our undergrad. And the first 4 years was largely India, right? So 2008 to 2012 was largely very focused on India as a market. We then went on to raise our Series A in 2012. This was Sequoia. 2014, we raised our Series B from Norwest. So in 2012 is when we really started looking out of India. So 2012 to 2020 was really India, Middle East, and Southeast Asia. I think we are definitely in the 3 or 4 largest SaaS companies serving India, Middle East, Southeast Asia as markets. In 2016 is when we raised the Series C from Warburg Pincus. We also went and did a couple of acquisitions in 2016. Sitting in 2023, I can say that those acquisitions didn't work out, right? But it was great learnings, right? So it was only in 2021 through COVID that we realized that, look, I think building a large, resilient software business would be impossible without having a large presence in the US. Right, so we opened the US in 2021 with a small acquisition, to kind of get our 0 to 1, a shortcut on the 0 to 1 really. That's worked out very well. Cut to today, the US is a little more than half of our revenues as the and we still less than 1% of the market in the US, so massive growth left. That's very quickly where we are.
Well, lots of bold calls there, right? 2021, when everyone was like hunkering down, going for an acquisition in the US, that's no joke, right? So, I mean, and great to hear that that acquisition is actually panning out well, and you've been expanding well into the US, right? Now, growing up, all of us, when we heard software from India, the first thing that would probably come to mind is services companies, right? Like an Infosys or a Wipro or, an HCL. As I understand, Capillary is, one of those beacons of product companies coming out of India. Can you, as a founder, CEO, share how you manage that tension of like building a product versus a services company, and how does that feel like from somebody operating it, especially in the context of working with these really large marquee enterprise names you spoke about?
I must say that, like many things in life, Karthik, I think markets do a lot with you, right? So, and as you know, we started in India, and I think India anyway never paid for services. So, right, so you were better off building a product, and if you had a better product, chances were you get paid like significantly more, right? Which has been our case. Even in India, I think our next closest competitor probably charges a tenth of us, right? And we've still constantly won the best and the largest enterprises on the back of a very, very strong product, right? Uh, so Asia anyway doesn't pay for services. So it was not like there was a services market that we could go behind, given we started with India and then expanded into Asia. The other side, of course, was, just given our backgrounds, given the fact that, most of the initial team ended up coming from IIT Kharagpur or BITS Pilani. Those were the two mafias that we still have in the company. A lot of the talent wouldn't have been very happy building services, right? So, and that more so gravitated us towards building like really scalable large enterprise tech, right? So, when we pitch our product to some of our competitors in the US, or to large companies in the US, they're amazed at the amount of scale we can handle. India is, of course, a large population, right? Being a consumer facing product, you end up having to build that scale yourself. So, and it's a combination of those two. I'd say market, I think there's more margins in product in Asia than services for sure. And the second piece was you just get much better talent if you focused on building products.
And it sounds like your product is, opening a lot of doors for you. Can you talk a bit about how your synergistic acquisitions, right, in the US with some of these marquee names as customers of the ones that you'd acquired, tag along with the product that you have, is, helping you actually grow at the clip you are 15 years still into, your founding?
Right. So, I think the US is really a baby business, right? I mean, we're 2.5 years into the US. Having said that, it does hundreds of crores in revenues. So, by calling it a baby, I mean in terms of potential where it can be and where it's today. I think it's really early days, right? So, again, on the US, I think the US has always loved great products, right? So, and if you look at the US as a market, more than 50% of all software sales even today happen in the US, right? Another 25-30% happen in Europe, and Asia and the rest of the world is the other 15-20%, right? So, so on the US, I think where we lucked out was what Asian customers make you do really well is build super deep products, right? There's a lot of nickel and diming. There's a lot of pushing you to build like really good products. And in our case, because we built those for the best companies in each of the verticals, right? Like if you look at it in India, Middle East, and Southeast Asia, we'd have the best brands in each of these markets as customers. So when we then took the same product to the US, I think like we initially started off, obviously we did this in COVID in 2021. So you didn't have too much margin for error, right? So it was a slightly risky move, although because we didn't do a large acquisition, we could have written it off. It didn't work, but still, right in the middle of COVID, doing something was. So the first port of call for us was the analysts, right? Unlike Asia, where you don't have large analysts like a Gartner or a Forrester being very active, the US is an analyst-led market, right? So for everything, you have very deep analysis on the space, etc. So our first port of call was really Gartner and Forrester. And when they saw the product, and because we had taken a Gartner subscription in 2012 or 2013, we realized that we were going and telling customers in Asia that, hey, we work with Gartner, rather than, the other way around, right? In the US, it's like
Yeah.
if you're a software company, you work with Gartner or Forrester, and all large enterprises work with them. Asia is very different, right? So we canceled our subscription, then we restarted it in 2020, right? And when we went to them, so this was after an 8-year break, right? They were extremely surprised that we had ended up building such a deep product, and we've always taken this vertical specific view on what we do. So we pick a vertical, build deep, and then start selling in it, right? Rather than
Mhm.
spray and pray that try 20 verticals at the same time. And so they actually the Forrester folks are known for their marketing tech analyst work, right? So they said, look, we don't know if there's a deeper product than this in the US, right? So and then so that gave us a bunch of confidence. Then our first hire in the US was really someone who had scaled a loyalty company from 5 million to like 60 million, and then he exited that company. He was on a break kind of a thing. So we got him in as an advisor. And again, his view was very similar, right? So as we spoke to, I think we did like 40, 50 calls over a 3-month period. We went to GLG to find experts who could look at our product, help us think through all that stuff. So by the end of 2020, we were reasonably sure that, look, it would be it would be a blunder if we didn't bet on the US. Right. So and now again on the US, of course, when you're selling to large enterprise, what's super important is risk, right? In large enterprises, they think more about risk than the amount of dollars they're paying you, right? Which is why do you have enough referenceable customers? No one wants to be the first guinea pig in a large enterprise, right? You have enough employees. Do they understand how to sell this? All that stuff, right? Which is why we went with the model of saying instead of a 0 to 1, which would probably take us 5 years, can we do a small acquisition? So we bought a small company out of Minneapolis, 5 customers, 15 employees, 2 very large customers, John Deere and Dell, and 3 small customers, right? And basically to answer this question of referenceability and risk. And that started off our foray into the US. That company ended up growing about 6.5 times in 24 months. We rebranded it from Persuade to Capillary. So it's grown really well. And most customers sign up with like a little less than $1 million initial ticket. So that's worked very well. Now that's given us confidence on two sides, right? So the organic obviously has done very well. This 3.5 to it took them 8 years to get to 3.5 million. It's taken them like 24 months to grow 6 times from there. And it's largely been because the product is great and it's a good team. Right? So the combination has really got us into a nice place. Now, as we looked at the rest of the competition that we have in the US, we realized that most of these companies are, old school agencies, good book of business, extremely sticky, customer set. So Forrester says that the average customer sticks with their loyalty vendor for 11 years. We said, can we go buy some of these companies out at like a CAC substitution model, right? In SaaS, if you break even on new sales in about 12 months, that's brilliant. In large enterprise, if you break even in about 24 months, that's good, right? So if you're able to get acquisitions in the, I'd say around ballpark half to 1.5 times revenue, a good book of business, large enterprise customers, then it just makes a lot of sense to go to them, right? So this year, we bought a couple of companies earlier in the year. Again, same view, large enterprise customers. What we've been able to do very well, Karthik, is also get into a customer and grow them significantly afterwards. So that's slightly the old, if you ask me, the old services play. Like if you look at Infi or any of these companies, it's really 100 or 200 large accounts where they get in and then they scale, right? So that's worked very well for us as well. So we picked a customer like Dell. When we bought Persuade, they were $1.5 million. Today they spend 5.5 million on us every year, right? So you get in and you sell them smaller pieces on the side. You expand more into other verticals, other parts of their business. So for us, acquisitions is played that way. Get in with a CAC substitution type model, and then scale these customers at least 20-30% each year. Right. So that's been the story, and it's kind of worked out well. I think the unit economics have really been good.
Well, maybe then just diving a bit more into unit economics, right? Can you talk about a few rules of thumb that you look at, one internally running Capillary, and also when you're looking at acquisitions, what kind of really are those three or four metrics that you go by to assess the quality of the business, the quality of the earnings, revenues, etc.
Right. I think the metrics on what we look at in Capillary and what you look at when you acquire are very different. Because largely you're buying these companies for a very specific purpose, right? Which is a customer side. Let me touch on Capillary first, and then I'll get to.
Hmm.
I think good SaaS companies really have three or four large metrics. So the first is gross margins, right? And given these are multi-year contracts, like so, the average contract for us is about 5 years. But the usual customer stays for 10, 11, 12 years, right? Our first five customers, other than Future Group, which went bankrupt, everyone else still continues to work with us, right? So, and it's like 14 years, 13 years time frames, right? So gross margins is very critical. If you're a large enterprise, I think you can get away with like a 70-75% gross margin because it's stickier revenues, they stay for longer. Lots of ability to scale those revenues over the years. If you're SMB, probably 80-85% is the right mark because stickiness as well as ability to scale is much lower in SMB mid market. Right? So similarly, the second metric is really break-even months, which is sales efficiencies. Right, the first one was efficiencies on operations. I think the second one is break-even months. As I said, if you're a mid-market SMB focused play, about 12 months is great. I mean, it's good. If you're large enterprise and 12 months, that's brilliant, right? So because large enterprises take longer sales cycles, but they stay for longer, right? So it's the in large enterprise generally you want to be between 12 to 18 months of break-even on your sales. Right. The third metric we track on the sales and marketing side, which most SaaS companies don't, is actually how much of our growth is coming from farming, which is how much of our growth is coming from existing customers growing. Right. So, and if you want great predictability, that number has to be between 50 to 70%. Right. Unless you have, because, in a new deal, you really don't know how that new customer's procurement works, their approval cycles, all that stuff, right? In an existing customers, you know how that works, right? So if 50 to 70% of your sales is not coming from existing customers, then predictability starts getting hit, right? Of course, then there's the CAC by LTV, which is customer acquisition cost by, lifetime value by CAC. Lifetime value by CAC. It needs to be at a bare minimum of 3, right? So in our case, we are at more like 8 to 10 times. Again, because good gross margins, very sticky customers, they stay along for long. Finally, of course, you have the rule of 40, right? Which is your growth rate plus your the free cash that the business generates. If it's 40 or more, then you tend to get a 10 times revenue in whichever market, right? Even if you looked at the market of last year when all of SaaS was in the dumps, companies like Aviva, ServiceNow, the ones that really have stuck to the rule of 40 with decent margins, still made it through on the on retaining that kind of a multiple and not crashing down, right? So I think those are the key rule of thumb type metrics that we tend to track. On the acquisition side, it's very different, right? What you really want is so one metric we have is an average annual contract value of at least $1 million, right? So because we want to get into these large enterprises and then scale, right? So that's second. We usually see is poor tech. That the customers like the team, but the technology is not good because our tech is really good, right? So then it becomes extremely complementary. And customers also understand that, look, I'm getting a best-in-class product, which is, by the way, this year we rated, this is the first year we got into Forrester Waves, but we are rated as the best product globally on the Forrester Wave now. On all metrics, they have 2 axes. On one axis, we're anyway the best. if you do both, then we are the second best globally, right? So for a company that we acquire now, their customers look at it like, okay, we're getting a free upgrade to best in class tech at so that's the second metric that we tend to look at. Third is of course price, right? I think acquisitions are all about how much margin for error can you leave, because you'll always have surprises in acquisitions. So if you're able to get stuff at a decent price, do the deal. Otherwise, don't. Right. So and hence, our preference has been buying companies which are very value. Like we bought companies which are at minus 50% EBITDA and got them to profitability in the first quarter, because we really don't need those tech teams that they have. We don't it's very easy to say, look, in 12 months these customers will move, or in 18 months these customers will move. How will that org look? And say, look, here is what I need to keep lights on, right? So very different metrics really. If you look at what we look at in Capillary and what we look at when we buy, right? So
Well, I guess I'll ask your favorite question for every founder, right? Which is, what do you think investors get most wrong when they evaluate SaaS companies, or makes you go, ki, yaar, isko to chamakta nahi hai about our business? What are a few things that, you felt over time that are most, difficult for people outside the company to kind of like evaluate, whereas it's very obvious for you?
I must actually say that unlike most founders who loathe meetings with investors, right from 2009, right, KK and I would have, KK was my co-founder, and I would have this rule that we'll meet 2 investors every week, right? Because we felt that, look, whether you like it or not, some of the smartest questions come from them, right? And it was a great way for us to. This is 2009, right? Before we really started all our big fundraising and the 150 million we raised over the years, all that stuff, right? So we would make sure we met 2 investors every week, right? So, and we would get a lot of these inbound emails, right? So in fact, till now, we have never raised money using a banker, right? It's always been inbound. It's always been relationships that we met earlier, all that stuff, right? So I do believe that investors ask good questions, right? Now, have we been passed on many times, right? Like incredibly many times, and there've been many times when people have got it right also. Like once we got through our Series C, I think we didn't. That was 2016, right? We raised our Series D only in like this year, in 2023. So 7 years we didn't raise much. Although because Warburg came in with a mid-sized check, they were very keen to double down, so they kept doubling down. So we didn't need to go out much as well. But one big question used to be this: you can't build a large SaaS company out of Asia, right? And we were at like a few hundred crores in revenues in Asia. And I'd keep saying, look, hey, this doesn't make sense, right? We're scaling so well, and no one seems to be seeing this, right? So now cut to today, I would say probably they were right? That this is the kind of scale you can get in the US is just incredible, right? It would take you. We are the same size in the US now as in 15 years it took us to get to in Asia. It took us 2.5 years to get to there in the US, right? So, but of course, I think there are. The thing that I feel, again, right, for a very long time, we were written off saying, why will large enterprises in the US buy from Asia? Right? So, and there was this whole, people were looking for this, hey, where is the cost advantage type math, right? While I think when you're in a product business, and especially when you're selling to large enterprises, it's about how good is your product, right? So, I think hopefully now you're starting to see investors turning around and saying, hey, like, look, if they have 15 out of the Fortune 200, then probably they'll have another 50 in the next 10 years, or in the next 4 years or 5 years, whatever, right? So, I think, yeah, so some of those pieces, I'd say, what are the other ones? For a very long time, I think, at least in the VC world, there was this madness for growth, right? Like, that growth. Like, you won't believe it. Like, we got to our first cash positive year in FY21, right? Which is the year ending March 21. And other than people in the company, I don't thought no one else was like excited about it. It was just this madness of saying, look, just growth, right? Like we would have to tell people that, look, there's an EBITDA lying below and look, here's the number. Like no one even gets to there on the. I think some of those are quirks
Mhm.
from especially the VC world, but but I do believe that investors ask some of the smartest questions. So, like, yeah.
I guess profitability is less exciting because then the company's fate is in the company's hands, right? Not in VC's hands. Anyway, moving on. Yeah, do you believe,
That's interesting coming from a VC.
do you believe that then SaaS companies from India now are at a position of like advantage? Because 15 years ago, when you got started, uh, SaaS was probably, a very unknown kind of concept being built out of India, right? To now, where it seems to be one of the hardest sectors. Do you see an advantage? And if you do, what's a durable advantage that you see for Indian SaaS companies?
So let me give you two stories, right, and tell you how the world has changed in the last 10, 12 years. So this was 2012. One of the first markets that we opened internationally was the UK, right? So it was Asia, of course, Singapore and Dubai. And then I'd done a trip to the UK then, and I was attending one of these uh, retail week events. You know this, right? We started with retail as the
Mhm.
primary vertical, and then over the years we've added more, especially in the last few years. And and I used to do this thing of standing just beside the stage. Once a speaker walks down, you would go ask for a card and you'd call them up the next day, right? That was 50% of our new business in Asia. So it's just this small hack. So I did the same thing in the UK. Stood beside the stage. The guy walked down, and I don't even remember who this guy was now. And I said, "Look, we are a product company from India," and before I could even say one more word, he said, "Hey, we don't outsource services to India, right? So gone, right? So cut to today, we have the really good brands from the US or even the UK now as customers with us, right? So this whole question of people do buy products from Indian companies now, and I mean it's just a massive mindset change that you can see there, right? So the second was we actually got one of these customers from the UK to come to our office prospect, right? This was I think Holland and Barrett, if I'm not wrong. They actually flew down to Bangalore. They came to our office in Bangalore. This is again, I think 2012, 13, sometime around that. The guy somehow said, I don't know what I'm doing in India buying, in Bangalore, buying, like evaluating a product here, right? I mean, and that just struck you, right? So, and now we just had a board meeting where we had like a Fortune 100 CXO flying down for the board. And we do this thing where we get customers down for, a 45-minute interaction with the board, so it keeps the board also honest on what do customers actually want and all that stuff, right? So um, and so it's like a really changed world, right? So and I think a lot of SaaS from India for the longest time was what Zoho, Freshworks, ChargeBee, a bunch of them did, right? Which was SMB mid-market SaaS. So you were really selling at that $10 to $20 per month per seat pricing. You were setting from here. There was a lot of efficiencies on doing it from here. It was typically SMBs that bought from you. So for them, price was more important. All that, right? But if you look at the last 3, 4, 5 years, that's changed significantly, right? So if you look at an Innovator, Zenoti, a Capillary, an Amagi, a Browser Stack, even a Whatfix now, which has moved from SMB to large enterprise. All of us are winning like $500,000 deals, $1 million deals, right? So, one of us recently won like a $30 million ARR deal. So it's a changed world. Like so, I mean, these same companies in the US are now like, yeah, I mean, like, where do the best products come from? We'll go there, right? So, and
Mhm.
what's also helped a lot is if you look at the Forrester Waves or the Gartner Magic Quadrants, you will see like Capillary or a Whatfix or any of some of these companies in the right hand, top, right? So you're either the best or you're the second best or something like that, right? And once you have that kind of validation and you have decent presence in the US, why would these companies not buy from you? And as we all
Mhm.
know, 90% of software spends end up happening in large enterprise, right? So it's just how skewed that market is. So I feel super excited about prospects for India SaaS, because I think the advantage with India is you can build deep products at good value. And when I look at Capillary, we have 250 engineers from the best of breed colleges here, right? None of my competitors in the US can afford more than like 40, 50 people, right? So it's just depth of product, right? And if you have deep products which are extremely well verticalized, which are, why would the best of customers not buy from you? Right? So I'm personally, very excited about, I somewhere deep down, having been part of this journey for 15 years, I do believe that sometime in my lifetime, SaaS from India will be as large as services from India.
It broke for a bit, for like 5 seconds.
No, the last line I said, Karthik, was that sometime in my lifetime, I do believe that SaaS from India will be as large as services from India.
Incredible. Uh, one thing that's not very clear or obvious to those that don't operate in the India SaaS ecosystem is how does this kind of translate into operations, right? So does it mean companies such as Capillary, Innovator, the names that you mentioned, Browser Stack, etc., start hiring in the US and growing teams here, or are you able to do sales and win these multi-million-dollar contracts, right? You said $30 million ARR. That's incredible. Can you talk a bit operationally about how this is working out? Because I do understand a lot of them are beginning to, build presence in like California and rest of the US, right?
Yeah. So I think look, if you're focused on large enterprise, Karthik, sales and marketing, sales and customer success has to be local in the US,
Mm-hmm.
right? I mean, if these look, and let's understand this, right? A lot of these companies that I just mentioned are not winning on price. If anything, we are probably 10, 15, 20% more expensive than most of our competitors, right? So, and so it's on the back of a really good product, right? So I think the right way to think about it is that sales and customer success come from in market, while product engineering delivery comes from India, right? So, and that's broadly the model, at least a lot of the large enterprise focused SaaS companies have taken. The mid-market SMB ones like a Freshworks, Zoho, or ChargeBee, etc., also run sales and marketing from Chennai or from India, right? So, but I think the efficiencies. Look, India has great talent on engineering and product, especially if you look at Bangalore or if you look at uh, like a lot of these large global, the Googles of the world, the Adobes of the world, build significant part of their product from India now, right? It's not just the backend
Mm-hmm.
services. You also have really good, like Google Maps is built out of India, I'm told, right? Fully. Apple Maps is built out of India, fully, right? So you do have like really good product and engineering talent in the country, and I think that's where the advantage is, right? I mean, we're not, as Indians, we're not great at sales and marketing. Let's agree to that. And I mean, you stay in the US, right? Marketing, US just gets marketing like no one else, right? So, and so that's been our model. We've said sales and marketing stays local, uh, and you do engineering and product and delivery from Asia. Now that still means that you have great efficiencies, right? Like the like you can get, it's not 1:10 like it used to be earlier, but for one good engineer in the US, you can get three good engineers in India now, right? It's, I mean, obviously there's been like massive escalation on salaries, all that stuff, but still that's like great advantage, right? So delivery, of course, right? You can run really good implementations and really good delivery from India. I mean, that's more natural to us as a country than anyone else, right? So, and given great products, I think you see, say, like we're able to grow at the same pace like at the 30-40% clip organically. Inorganically, of course, we're growing a lot more in the US with a 25% investment in sales and marketing compared to US companies which invest 60-70% of revenues on sales and marketing and are growing at 20-25%. I feel the delta is actually in the product. Because you have a more superior product, you tend to convert faster, you tend to convert better. Right? So, and because you tend to, so a bunch of that, right? So I think you definitely have the India advantage in SaaS for sure.
Which tends to be a common criticism, right? For like, a lot of US SaaS companies, in spite of like, running for like multi-decades, they're still not profitable. They have like sales and marketing at like 30-40% of revenue. So you're saying that India SaaS would kind of have that competitive advantage over time, given products are probably as good or better, and we have like, cost advantage, right, from the India perspective.
Yeah, I mean, if you're spending 60-70% on sales and marketing, you will how will you make money? Like, it beats me on, how you make money, right? While if you're able to show the same growth at 25-30% sales and marketing, then, you have a good chance of getting to that 20% free cash or that 25% free cash, right? So,
You touched a bit on this, Anish, but can you talk about, in the last 15 years, how have just, the talent and capital markets in India changed in, specifically software, if you will?
right. So let's talk about talent and then we'll talk about markets.
Mm-hmm.
Right? So, I think on talent, look, I think 2008 when we started, my own dad didn't want me to start up, right? Right. So, and it's incredible the number of, if we were trying to get a really good employee, I've actually had one prospect employee's father-in-law talk to one of our investors, this Karthik at Qualcomm, to give him assurance that, look, the company is doing well. It's going to sustain. Right. So it's just crazy, right? I mean, if you look at
Mm-hmm.
how 2008, 9, 10 were kind of and where the markets are now, right? I mean, I think uh, other than probably a Google or a Microsoft, the next port of call for good employees is eventually startups, right? Whether it's the IITs you go to, whether it's the IIMs you go to, or even ISB for that matter, right? So you do have, I think that world has changed. I think folks have seen, people have bought their first houses with ESOPs, etc. So there's real wealth, right? So people have seen that real wealth, those stories, uh, like the alumni that get celebrated now when you go back to campus are mostly founders, right? So culture matters, quality of work matters, purpose matters, and you get those more in startups than in large companies, right? So I think that's been amazing, right? So it's definitely driven great talent to come in. Like it's incredible. Like I mean, even if you look at us, we've been able to get very senior folks from a Dell, from a Adobe, from a Cisco to come in and join us. Our of course our entry level hiring has always been like really good. Right? So, but of course, what it's also come with is like massive escalation on salaries, right? So unlike the IT services world where entry level salaries have stayed at 3 lakhs per year for like 30 years, for 3 decades, that's not been the case in software products, right? So I think you have to pay for good talent. Especially the last 2 years was madness. At least this year has been like a lot of rational behavior. That's on talent, good talent. Probably if you had a 10 times advantage 10 years ago, you have a 3 times advantage over the US, but it's still an advantage, right? So on markets, it's interesting, right? I think um, you do see markets. Are you talking markets from a customer standpoint or from an investor standpoint? Just to clarify.
From an investor standpoint.
Got it. From an investor standpoint, so we did our roadshows like earlier, end of last year, early this year, both in US and and India, right? We met a little more than 50 large funds. I think pretty much everyone. It was good. It was great learnings. Told me in the face that, look, we are not ready for this, which prompted us to then go to a Series D. But I think the learnings um, were I think, look, I think there's the good piece is almost everyone who is in IT services wants to look at SaaS and products, right? So we got a lot of meetings, right? So although we are not a very large company, we did get a lot of meetings, right? So and which surprised me, right? So you met the SBIs, you met the ICICIs, you might like name a fund, and you kind of could get a meeting with them, right? So there was definitely a lot of interest, and we, the first or second SaaS company to even try the markets out, right? No, but I think the learnings were pretty simple. I think the learnings were that a $10 million of free cash or 100 crores of free cash is when I think you should really try an IPO in India. That's when you're kind of like an all-weather company in some senses, right? There's nothing all-weather. But still, I think it's better positioned than going out when you really will see like you'll get very badly hit in a bad market rate. And the second learning I got was that I think going out when you're let's say 5,000 crores or more if you're growing very fast, or $1 billion or more when you're growing, let's say at the 15%, is the right threshold. That's when you really start getting the right investor. So we got a lot of meetings, and and we went back and asked them, look, like if when I decided to pull out, which was in Feb, that we won't do the IPO, instead we'll do a private fundraise, and we raised about 40 million-ish, right? So we're well placed for the next few years. We did go back to a lot of these folks and ask them, look, if we have to come back, what is it that you would want to look at in us? So I think there were a few good tick boxes, that large enterprise, very good logos, good governance, right? Some of those were easy tick boxes, which they felt were good. I think the two pieces that came back was, look, I think if the company was more like, even in a bad market, could be at like 5,000-6,000 crores in market cap, would make it more easier, simpler. No one can play the stock, then those kinds of learnings. And if it's, of course, more than $1 billion, then, it's like much more easier, right? So I think that was one big learning. In the US, of course, we, half the road shows were in the US as well, right? So, and funnily enough, what we saw was the same fund, right, would say in the US, my threshold to come into a company is 5 billion, the same fund. And in India, that number is more like $1 billion, right? And that was very eye-opening for us, because to build a $5 billion company in the US in a bad market where you, let's say, get 6 times revenue, I'm just using some broad multiples, you need to make 800, 900 million revenues, right? So which is, and SaaS by itself, products by itself is going to be, you want to be great at a $10 billion addressable market, right? Or a $20 million addressable market, right? It's not like services that I'll do everything for you, right? While, and hence I think it's in fact, even RateGain now is done very well. Affle, which is not SaaS, it's more ad tech, is doing quite well. So I'm personally very excited about, how the next 10 years might look for products listing in India. I think the threshold is still going to be, you have to be profitable. So the US math of, we don't care on what your EBITDA is, I don't think will fly. You'll have to get to that threshold of, I think, 100 crores of free cash or 80 crores of free cash or something like that. But I think once you get there, I think you will get a lot more premium in markets here than you will get in the US, is my gut.
And so you do subscribe to the view that there are a lot of companies on the ramp to like list potentially in the next 2 to 3 years in the domestic markets, SaaS companies that have been building out. Some names that you probably spoke about, but, kind of like maturing to the level where they would tap into capital markets, potentially domestic, for reasons that you mentioned just now.
Absolutely. I do think, look, I think if you want to efficiently grow at that, 20-25% generating free cash, I think you can do it more. I mean, like $1 billion market cap seems like real, and then you grow at 15% every year. I think the place
Hmm.
where I think US companies struggle is you have to get to that $5 million to be relevant. And hence you keep blowing all this money into like sales and marketing to get to scale. Right. And hence your efficiencies all over the place are extremely messed up. Right. So I do think India, that the fact that Indian markets treat $1 billion companies well, I think is a big advantage for both companies in India as well as, I think markets itself. I think you will see a lot of that uh, happen over the next, at least in founder circles and SaaS. I can tell you that more people are interested in going public in India now than they have ever been. Or like earlier, there was no question, right? Like people would say, why would you go
Hmm.
public in India? Now, I don't think there is, like, everyone is seriously evaluating. Uh,
Of course, I mean, when you list in the US, it does come with the cloud of EM, right? And so uh, early quarters, if there is any, miss in revenues or earnings, you kind of probably ignored for the good, right? And so, yeah, it makes a lot of sense. Uh, Anish, you spoke about like cycles and companies. You used the word value SaaS, right? And you also spoke about metrics. You clearly spoke about four metrics, that you would look at when you're evaluating SaaS companies from an internal perspective. What confluence do you think of those four factors do, confuse investors to the extent that they're either undervaluing or overvaluing these companies, right? Because value SaaS is primarily when, you're probably undervaluing the company, right? And there's an inflection point that you're missing. So any views there?
yep. Look, I think value SaaS for me actually more than just the investing side is also the customer side, right? Is I personally feel if you're spending way too much money on sales and marketing, then there's something wrong with your product, right? So value SaaS for a bunch of us is actually saying, spend less on sales and marketing, spend more on customer service, customer experience, spend more on product, right? So there's more value going to the customer than just, a great song and dance and a dog and pony show on sales and marketing, right? Which if you think of Oracle, Salesforce are brilliant at. And if you've
Hmm.
been to a Dreamforce, you will see that, right? I mean, it's a tech company organizing the largest event in San Francisco, right? So, and they get all kinds of rock bands, and it's just crazy, right? So that's value SaaS a little bit, if you ask me, for us. Um,
Hmm.
but yeah, I do think value SaaS is also about saying let's try and get to that 10% free cash at least, right? Sooner than later. But I think just given how the US mindset has always been growth, 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 and not efficiencies, and how as Indians we are anyway brought up with this mindset of efficiency, right? I think we are more aligned to that mindset of saying, okay, like let's run this well. It's okay to grow at 35-40%, and not try and attempt that 60-70% growth and burn through a lot of cash, right? So
And definitely after 2022, I think that is pounded even deeper into our psyche. So one last
Karthik,
question
I
for me,
feel
Anish,
I
to
feel
close
all
out.
these are all these. I think human memory is like extremely short term. If 2024 is this brilliant, you know, uh, grow at all cost year, oh, everyone will run back to that.
That is
It's just
true.
how it is, right? So
Hopefully ChatGPT or the algorithms remember it better than human memory. But you're a prolific angel, Anish, and I think your bets on people have always been stellar, right? So could you share a few things that you look for when you're hiring talent, when you're investing in people? What qualitative aspects do you look for, uh, and what does culture mean to you? And with that, it's been a great conversation. Thank you.
I think culture means everything, Karthik, right? So we learned it the hard way with our first acquisition. That culture eats everything else for breakfast, right? So if you have bad culture, God bless you, right? So and also I think I've been incredibly lucky to see some very hard cycles and like COVID, we lost 80% of our revenue, all that stuff, right? So, but the team stuck around, right? The interesting part is, I think people value culture, right? So, we have a wall in our office where we put a photo for everyone who spends more than 10 years with us. Just a photo, right? And we have 96 people on that wall now, right? So, compare that with other startups, so culture works, right? So culture definitely works. We in fact put a value to culture saying if your culture is good, people won't jump unless they get more than a 40% salary, which is why our comp ratios, which we look at every year, are 75% of market, right? Because we know that people value culture to be the other 25, other 30 actually. We left a buffer there, right? So culture is extremely crucial. So in terms of people, look, I think what's worked for us is there are, I think, two things that we try and see when we hire. One is, will they stick around when things are bad, right? So you try and poke around a little bit on, have people gone through bad phases and how did they behave then, right? If they just jumped when there was a bad phase, then because cycles happen in business, right? Fact of life is cycles happen in life, not just business, right? So that's one. The second is, of course, we've always been this company who felt that letting go someone is better than treating them disrespectfully, right? So we have this total policy of no brilliant jerks. So you really want to reference around that and make sure you're not getting any brilliant jerks in terms of people. I think, look, I think those have been the cultures that have really worked for us. I mean, we have an org manifesto that's on our website on what are our values, what's our beliefs, but that's a full 1 hour conversation. That's not for a quick chat.
Wonderful. Thanks, Aneesh.
Thanks, Karthik. Thank you.